let's get started. So good morning, ladies and gentlemen. Welcome to today's webinar, an introduction to the EU Taxonomy Sustainable Finance Disclosure Regulation, commonly referred to as SFDR. My name is Serkan Erol, and I'm the European Investor Outreach Manager at EPRA. SFDR is a European regulation introduced to improve transparency in the market for sustainable investment products, to prevent greenwashing and to increase transparency around sustainability claims made by financial market participants. As such, it is focused on the investor community. SFDR is a significant part of the EU sustainable finance agenda, the main objective being to steer the flow of public and private capital towards sustainable investments, and in doing so, lead the global transition to net zero greenhouse gas emissions by 2050, as well as achieve the objective of the Paris Agreement to limit global warming to no more than 1.5 degrees centigrade. We believe this webinar will be valuable for both investors in the listed real estate sector and the listed real estate companies. It is important for investors to know what is expected of them by the SFDR regulation. It is also useful for companies to understand what information is being requested of the investors. If there is a harmonized understanding at the outset, we will be able to work together towards net zero and the objective of the Paris Agreement. Today's webinar is presented in partnership with Baker McKenzie, a law firm with significant expertise on this, the EU Sustainable Finance Disclosure Regulation. I will introduce the speakers and the agenda for today's webinar before we start in earnest. Firstly, I'd like to introduce the Baker McKenzie team. We have Caitlin McKerlin, who is a partner from the London office. And we also have Amelie Waltrager, who is an associate in the Luxembourg office. Baker McKenzie will provide us with an overview and summary of the SFDR legislation, highlighting the key provisions relevant to the listed real estate sector and also comparing them to unlisted real estate provisions. So we will see the full picture from an overall real estate perspective. We will then move on to an industry panel discussion where the speakers will discuss SFDR's potential to green finance for real estate. We will look into the topic holistically from a real estate perspective. And we are therefore delighted to welcome Jeff Rupp, Public Affairs Director from INREV, the European Association for Investors in Non-Listed Real Estate Vehicles, who together with Jana Bohr, EPRA's ESG Policy and Advocacy Manager, and Amelie Waltrager from Baker McKenzie, will discuss the observations about the opportunities and constraints in SFDR's application and possible ways forward. The final special guest I would like to introduce today is Guylian Cowles, Senior Policy Officer from ESMA, the European Securities and Markets Authority. We will be fortunate to hear firsthand from our regulators some insights regarding the SFDR application and intentions to address greenwashing. This webinar is recorded, and only in today's live transmission will you have the opportunity to submit questions via the Zoom Q&A window at any time. So without further delay, I now invite Caitlin to take the floor, starting with a summary of the SFDR regulation.
Thank you. And hi, everyone. Thanks for joining. I'm a partner, as was mentioned, in Baker McKenzie's London office. And I think the fact that I work out of London and advise on these matters tells you something about the extraterritorial scope of them. They've been given an incredible amount of airtime within the London market, frankly. So just to start, the SFDR is often described as being one of the two sort of joint pillars of the European Union's ESG regulatory reform program. It sits alongside the taxonomy regulation, but it's really part of a much wider reform effort that extends across the entire spectrum of financial services regulation. One of the challenging aspects of the SFDR is that there are a number of different disclosure thresholds that are built into the text and that are rather unclear in their application. However, to try and keep things simple, there are broadly two sets of disclosure standards that apply under the SFDR. One is a requirement to make pre-contractual disclosures on sustainability, and the other is to make a public disclosure on the firm's website on its approach to sustainability, which is fairly detailed in nature. And what we mean by sustainability here is ESG. It's not just climate data. There are also social and governance factors to think about, although really in the real estate sector, we are primarily thinking about energy and efficiency and climate type metrics in general. So Articles 8 and 9 of the SFDR describe the categories of financial product that have an ESG focus and that are subject to additional disclosure obligations for that reason. The SFDR itself doesn't provide a huge amount of color on how those categories should be interpreted. It simply states that Article 8 products are products that promote sustainability in some way, and that Article 9 products are products that have sustainability as their objective. And there is a third category, Article 6 products, that cover the majority of sort of non-green funds, if you like, or funds for which sustainability risk is simply relevant in some way, and that have far more limited disclosure obligations. So when we're thinking about what could constitute an Article 8 or an Article 9 product, which is a question we get a lot, it's clear that what European regulators are primarily focused on is how the product's actually being marketed to investors. So they talk about information to investors in the broadest sense, whether that's the name of the fund, whether it's marketing communications, or whether it's mandatory communications to investors. And we do often see marketing documents around real estate and sort of the various credentials of real estate investments. So that's something to keep an eye on. A really important threshold comment is that although in the past, if I'd started out by referring to green and sort of dark green funds, for instance, you'd naturally have concluded that that was quite a niche market, but there is significant appetite for these products. I mean, we saw data from Morningstar indicating that in the last quarter of 2021, net assets of Article 8 and 9 funds totaled something like 4 trillion euros, which accounted for 42% of all funds sold in the European Union. So it's a sort of ever-increasing universe of funds. So in terms of scope, this is essentially a new disclosure regime that's designed to apply in a very standardized way across the entire financial sector in the European Union. And that scope of impact is very important to bear in mind, because this isn't just something that will apply directly to European asset managers, for instance. It will also apply to asset allocators. So European pension funds, insurers providing unit-linked products, banks providing portfolio management services, and so on, are all drawn within scope of these SFDR disclosure rules, with the intention being that the disclosures apply, as I say, in a standardized way across all of these different sectors. And one of the really challenging things about this piece of legislation for asset allocators is that they look at what they need to disclose under the SFDR and then think, well, I need to get hold of this data somehow and standardize it across tens, and in some cases, actually hundreds of external asset managers. So there's a real level of concern that we're seeing, particularly in some of these sectors, like certain insurance firms, pension managers, where they sometimes outsource a lot of portfolio management to third-party managers to try and get that underlying data, including on direct investments in real estate and other assets. So in terms of direct scope to investment managers, the rules, of course, apply directly to European Union managers. They also apply to non-EU managers that actively market funds into any European Union member state. EU firms with permission to advise on investments or provide portfolio management services also fall within scope of the rules. So firms providing single managed account services, sub-managers, banks, and so on. There are, very briefly, two sort of further features of the EU's ESG legislative framework that sit alongside and reference the SFDR framework and broaden its scope of application. So that would be the product governance regime and suitability framework. So if you have an in-scope product, whether it's a fund unit or an IBIP that's being distributed to European investors through an EU banker investment firm, that banker investment firm will need to actually define the target market for distribution of those products by reference to the target market sustainability preferences. And secondly, if you're distributing an in-scope product to customers in the European Union, where it's sold on an advised basis or incorporated into a managed account, European distributors will need to actually disclose information on the sustainability characteristics of the product and explain how their clients' sustainability preferences have been taken into account. And there's a very specific definition of the end investor's preferences for these purposes that refers to taxonomy alignment, which is a big thing in the real estate sector, right? Because you have to demonstrate that the energy performance of your real estate asset is aligned with the taxonomy. Commitment to investing in sustainable investments, as that's defined in the SFDR. So that sort of brings in the PAIs, and consideration of principal adverse impacts on sustainability factors, which again, there are some specific sort of real estate relevant sustainability factors. So just briefly before I hand over to Amélie, I think we've got a slide a little later on that we'll get to around common questions from clients. But I think before we get on to those practical issues, we wanted to sort of frame the discussion with 3 key practical concerns that we see clients grappling with at the moment at Baker's. The first is scope creep. The second is issues around product classification, which I think Amélie will talk about in a bit more detail. And the third is data availability. So scope creep, which is the first issue, is I think to an extent driven by European Union firms' compliance teams sort of worrying about the reforms, particularly given the very fast approaching disclosure deadlines next year. And in some cases, they're attempting to apply SFDR requirements in full to their delegates and others in the market as a way to mitigate their own compliance risk. So for instance, we've seen pension funds sending out slightly blunt instrument due diligence checklists ahead of allocating capital or making single managed account appointments, and EU managers actually requiring their delegates to put in place a full spectrum of ESG-friendly policies, including conflicts of interest policies and investment due diligence policies and so on. We've obviously also seen a knock-on effect on financing documentation. We've also seen regulators taking a very broad view of the universe of funds that these standards should apply to. So for instance, a lot of firms in the market were working on the basis that initially public disclosures that have to be uploaded onto websites wouldn't be extended to non-EU managers. And the view was that only pre-contractual disclosures, which can be slotted into offering documents, should be required. It's now clear that that's not the case, and that even firms outside of the EU should be making these website disclosures, which are fairly extensive. And finally, we've seen regulators take quite a broad view of products that should be brought within scope of SFDR disclosures. Most recently, we received guidance that even funds that are closed to new investments are required to make periodic disclosures under this regulation. That's not necessarily a result that some in the market were anticipating. And so you may end up getting questions around real estate investments that have actually been sitting in a fund for quite some time around SFDR. So these issues around scope creep mean that a lot of firms are dealing with continually moving goalposts when they're attempting to comply. So very briefly on product classification, we're increasingly seeing managers and others in the market sort of take a step back and now question whether they want to structure an Article 8 or a 9 product, or actually rebrand an existing product as Article 8 or 9. There's a couple of difficulties that we've seen with that. The first is figuring out that distinction between product classes. ESG tends to be a key focus for the business in a lot of cases. So investment teams and marketing teams are happy to go along with whatever guidance they get from their legal teams, but it can feel a little bit unclear around what's actually required to structure an Article 8 fund, for instance. And we found it's helpful for clients to go through a list of data fields, such as the PAI fields, to figure out workability. However, in some firms, you come across the issue that they like to give PMs and traders a fair amount of flexibility in terms of investment strategy. So that makes it challenging sometimes to come up with a sort of common firm-wide approach to characterization. And then the second issue is actually ensuring that legal and compliance teams have a handle on what's being marketed in practice and what marketing documents are actually saying around underlying investments or funds. So actually understanding how your sales team are characterizing products or investments is really quite key to managing risk. So final point, if you tune into any webinar on ESG, you'll hear some reference to issues around data availability. It is a real issue. Firms are struggling with it, of course, and regulators, I think, knew this in advance. They wanted these rules to drive data production. In a sense, principal adverse impact fields are very prescriptive. In particular, will need to be disclosed against the firm's share of investments in underlying investee companies that perform either well or poorly against the metrics that are set by the SFDR. They aim to track indicators relating to social and employee matters, respect for human rights, anti-corruption, anti-bribery, in addition to the carbon emissions sort of footprint of the portfolio. So it's a very broad range of data that needs to be included. We often get questions around what happens if you can't get access to that data on underlying investments. Where it's not readily available, there is an answer in the Delegated Act. It essentially suggests that you should use your best efforts to obtain the data directly from investee companies. And where even despite those best efforts, information can't be obtained directly, you'll need to fall back on and actually describe in your disclosures reasonable assumptions used, additional research you carried out, and use of third-party external experts or data providers. Of course, as many in the market know, modeling can really only get you so far, and it's not a real replacement for data. Just yesterday, we also saw that ESA's released their consultation on greenwashing. So I expect that will be a discussion that's ongoing over the next few months. So with that, I'll hand over to Amelie. Thank you.
Thank you very much, Caitlin, and good morning to everyone. Thank you very much for joining. So now that we are clear on the scope of SFDR, we need to ask a very important question, which is basically the second question that you ask, is to why and how do we address sustainability? What's the place of sustainability for a particular financial product? This key question will determine the regime or the scenario under which you will fall below under SFDR, and the level of disclosures that will need to be provided in the pre-contractual documentation and in the periodic report. So as Caitlin said, SFDR is all about transparency. So it's not a question of compliance, meaning that we do not need to comply with the requirements of Article 8 or Article 9. We do not need to be Article 8 or Article 9. We need to disclose to investors what is the current, let's say, consideration of sustainability with respect to a particular financial product. For some financial products, sustainability is not even a question. They don't take it into account because it's not relevant, because they are at the end of the investment period, for instance, because they have a portfolio of investments that is already invested, and there's no place, no possibility, or no available data to have a normalized ESG or sustainable policy applicable to all investments. And this is the case for scenario 1, where we say that sustainability risks are not deemed relevant. In that case, for this particular financial product, we'll need to indicate a clear and concise explanation of the reasons why we do not take into account sustainability risks, and whether in the near future, sustainability risks will be taken into account or not. In addition to this disclosure, there are the disclosures under Article 7 of SFDR relating to the consideration of principal adverse impact of investment decision on sustainability factors. This disclosure is due by 1st of January 2023. So a lot of our clients are already working on it, and we are assisting them in disclosing those information to make sure that the products are compliant as from next 1st Jan. So that's the first scenario. The second scenario, if we move on to the next slide, scenario 2, we are going to further, let's say, in terms of consideration of sustainability, because we say that we take into account sustainability risks. Those are one of the criteria taken into account when considering investment opportunities. And in that case, we need to disclose in the pre-contractual documentation of financial products. So usually those are PPMs, websites from the IFM, managers, advisors, management companies, policies as well from those actors, and any marketing documents that is provided to the investors. We need to disclose how sustainability risks are integrated in the investment decision process of the financial market participant, and the results of the assessment of the likely impacts of sustainability risks on the return of the financial product. So basically, we explain what's the step in terms of investment decision, how we take into account sustainability risks, and in case those sustainability risks are too high, if we move on to the next slide, there is a gap, let's say, between those two first scenarios where basically there's no commitment in terms of sustainability, and scenario 3 and 4, which are Article 8 and Article 9 funds, for which it becomes binding on the financial product and on the financial market participant to meet the environmental and or social factors that have been designated for these particular financial products. So scenario 3 relates to what we call Article 8 funds, which are light green funds, which promote environmental and or social factors in addition to governance factors as part of the factors for investments. In that case, we need to disclose what are the particular factors that are promoted, how those factors are met. In case an index is designated, the adequacy of this index with the factors promoted, and the calculation of the methodology of the index. And in addition to these disclosures, we need to add the disclosure that we've just seen for scenario 1 and 2, being how sustainability risks are integrated in the investment decision and the results of the assessment of the likely impacts. So in practical terms, this means that the pre-contractual documentation, the PPMs and marketing materials, will need to provide a section explaining what is the view, the position of the financial product and the financial market participant with respect to sustainability. And there will be, in addition to this general section, like explanation of the consideration of sustainability, a template pre-contractual disclosure, which is a template that was adopted by the EU Commission. And this will need to be completed with respect to the question that they raised, and they are very, very detailed. We will see an example in the course of the presentation, because it's one of the comments that we raised with respect to the particular template disclosures. So we are now under Article 8. Article 8, we have a promotion of certain environmental and or social factors. Those are for light green funds, and the biggest commitment for financial products is what we call dark green funds. So moving on to the next slide, that's the last scenario, scenario 4. This relates to financial products having sustainable investment as their objective. We often call them impact fund or dark green fund, because the purpose of those funds is to invest in assets and to perform economic activities that qualify as sustainable and within the meaning of SFDR and taxonomy regulations. And in a similar vein than for Article 8 funds, we need to describe what are the particular environmental and or social factors targeted and how they are integrated in the investment policy or strategy of the financial product. Most of the time, those factors are aligned with taxonomy regulations. So clients use climate change mitigation, climate change adaptation, because those concepts are defined. But in addition to those environmental factors, there are also social factors for which we do not have any taxonomy for the time being. It's under discussion, of course, but it is very important to make sure that if there are social factors that are integrated in the investment policy or strategy of the financial product, like reduction of inequality, etc. This is disclosed in the documentation because it's one of the factors that contribute to the qualification as sustainable investments within the regulation. So in addition to the description of the particular factors, we still have this index, the index that is here to assess the performance of the financial product with respect to the goals that were set for a particular sustainable objective. And this is a key tool for investors because this is where what we call the financial market participant will track and assess and report to the investors as to whether the commitments from the financial product with respect to the ESG goals have been met or not. And that's very important. And always, in addition, we have those disclosures with respect to the integration of sustainability risks, assessment of the likely impact, and the consideration of principal adverse impacts. So you see that the scope is quite, the scope of the regulation is quite large, but the scenarios are large as well. And the key point to remind is that it's a question of transparency. You need to disclose what you are doing, what is the ambition, and it's very important to be realistic and not go too far in the commitments in case the resources available do not enable the financial product and the financial market participant to perform as per their commitments. So I think we can hand over to Caitlin again, maybe on the timeline or the UK version of SFDR.
Yeah, Amelie, I don't want to take up too much time because I know we only had 20 minutes to speak about this, and I'm sure people want to hear from the regulator. Just briefly on the UK regime, because that may be helpful for people. We're sort of within the first phase of application that applied to very large asset managers with an AUM above 50 billion. And they're required to publish disclosures by 30th of June next year. After that point, the majority of other UK asset managers will be scoped into the new UK disclosure regime, subject to a de minimis threshold. But importantly, if you're established in the European Union, if you're a Lux manager that's marketing fund units into the UK, the new TCFD disclosure rules in the UK will not apply directly to you. The UK regime functions a little differently from the SFDR. It is based on the TCFD framework. So there's a narrower focus. It's really focused primarily on carbon emissions data, carbon footprinting across portfolios and so on. And it brings in those international standards. There's all kinds of debates about whether that's a better way of doing things, whether it's not such a good way of doing things, because you're then dependent on an international body that's a standard setter, that's potentially not so well resourced, for instance, as a local regulator. But there again, there's a higher degree of international convergence. So it's quite interesting to compare that to the European Union approach. We've also got a product labeling regime upcoming in the United Kingdom. It's rather more aimed, my sense is, at least at the retail market and the consumer market, than the SFDR was aimed at the retail market. The SFDR is really intended to bring in professional clients and institutional investors, I think, to a greater extent. But we'll see how that shakes out, because it's really still at consultation stage in some respects. And like the SFDR, the UK product labeling regime will be voluntary in nature, so you can choose to label your products in a certain way. So I think with that, I'll hand back over to the moderator.
Thank you, Caitlin and Amelie, for the overview of the SFDR legislation. Sorry, seems like my video is not on. Here we are. Sorry about that. Thank you. So now we'll be moving on to the industry discussion about the main SFDR and RTS impact on the real estate investments. Jeff from INREV will initiate the discussion and have contribution from both Jana and Amelie. Jeff, the floor is yours.
Thanks very much, Serkan, and thanks for inviting me here today. Obviously, the SFDR has had a huge impact in the non-listed real estate industry, as well as other asset classes and other industries. But initially, I wanted to just give you a brief rundown of the way we've viewed the SFDR regulations and some of the main challenges that we've experienced in implementing it, as well as the takeaways we're now using going forward. So many thanks to Annalie and Caitlin for their great presentation. I agree with everything they said, but let's maybe look at the next slide, please. And I wanted to show you the first focus on Article 8. Now, as Caitlin mentioned, Article 8 funds, if I can call them that for the last time, must promote ESG characteristics. And an important point here is that SFDR, Article 8 and Article 9 are not product labels. They are in fact disclosure regimes. And so funds disclosing under Article 8 must promote ESG characteristics, but we shouldn't be calling them Article 8 funds. That tends to skew the discussion and lead to some, I think, inappropriate conclusions. But Article 8 itself is primarily concerned with transparency and disclosure. So the fund has to have an objective that promotes ESG criteria and that's binding on the investment process. Clearly a stronger commitment than an Article 6 fund, which Emily and Caitlin both mentioned. But it includes the periodic disclosure requirements, the pre-contractual and periodic disclosure requirements that include the indicators used to measure the attainment of the ESG characteristics, and the quantitative data that demonstrates the funds promote ESG characteristics and how they don't run afoul of the principal adverse impact requirements under Article 7. There's not a specific minimum for the proportion of assets that need to meet the criteria under Article 8, but it's important that there is transparency. So this is an area that hasn't been fully fleshed out yet. The indicators that apply to real estate are very few, and only in the environmental area, not in the social area, which creates particular problems for social impact funds, but more on that in a moment. Let's look at the next slide then, and Article 9. Article 9 funds have to have funds disclosing under Article 9 must have sustainable investment as a core objective, and this is really important. All assets need to meet the sustainable investment definition, which includes the do no significant harm criteria under the sustainable finance taxonomy. The sustainable objective needs to be on par with financial return criteria, and the investment to sustainability objective and qualify as sustainable investments. What is important here is this objective is more than just an intention or a wish. All investments must qualify as sustainable at all time. And this is a rather static view of the portfolio composition, but it becomes very important as we look to the next slide, please. So the key challenges in the area of ambiguity for us relate specifically to when real estate funds can meet the Article 9 criteria. We had a lot of thinking early on when SFDR was not yet really in effect, that as long as a fund was attempting to make sustainability improvements, so in short, a transition fund, buying up brown assets, converting them to green assets, that should be able to qualify as an Article 9 fund. But in fact, we found that that isn't the case. Now, this for a lot of reasons, but specifically because the assets in the fund need to meet the definition of sustainable at all time. So what we found as a key challenge is that it's a very complex regulation. There aren't standards that directly relate to real estate. And this static view of the investment doesn't encourage a dynamic or a transition investment strategy, even though a goal of SFDR is to promote investment into sustainable assets, which for the real estate, in the real estate context, really do mean in most areas upgrading buildings from brown to green. So the stranded to green or transition funds may not disclose under Article 9, and this has been clarified for us by ESMA, but they would disclose under Article 8 because they would have an objective of meeting, sorry, they would have, if you look back at that other slide, the objective of, I've lost the slide, but of meeting key, sorry, they're primarily concerned and they most promote ESG characteristics. There we are. That's what I'm searching for. So there was a little bit of a disconnect we found, especially in the early days, that investors wanted to be sustainable, wanted to invest sustainably, and therefore made a quick assumption that they should invest in Article 9 funds. And we've been working very hard within the non-listed industry to let them know that what I've just mentioned, Article 9 is reserved for funds where all the assets are already sustainable. And Article 9 is not to be used interchangeably with impact. So the takeaway, the soundbite that we are using that we think is very helpful, and I'm really pleased that we've got ESMA on the line today, so Julian, to be able to talk about this hopefully further. But in our view, we're trying to dispel the notion that Article 8 is the silver medal and Article 9 is the gold medal. That's not the true. That's not true. Article 8, in our view now, is the journey, and Article 9 is the destination. So if you look at the takeaways for investment managers, I think the key, there we are. The key thing here is that these disclosure requirements are still evolving. We're looking for a lot more clarity, especially in the PAIs and the do no significant harm criteria and how they apply to real estate, particularly, as I mentioned, in the social sector. The unsettled status is created some uncertainty for us, and that creates regulatory risk, but this is a natural part of the evolution of the regulation, and we're looking for more clarification on that in the months ahead. So an important principle that we need to bear in mind as we think about Article 8 and Article 9 is that the main concern here is to stop greenwashing. And greenwashing sort of suggests a little bit a bad intention, but quite often this can just be green wishing, an intention to do something better, but the regulation really does require that there be measurable transparency and disclosures so that the claims and the objectives can be measured against the reality. So again, most real estate funds, especially those doing transition work, will disclose under Article 8. That's a very broad disclosure category. And we're also working, just to mention before turning it over to Jana, that we're working very much to get internationally aligned ESG reporting standards because they involve or applied to direct investment in real estate, listed and non-listed real estate investment, and will be applied in the US, in Asia, in the UK, and in the EU before all the different regulatory systems come up with their own regulations, and it would be most advantageous for the industry to have aligned standards in these areas. Jana, thank you very much for the opportunity. I hope I haven't run over, but turn it over to you now.
Thank you very much, Jeff, for your participation and for this input. I will invite now Amélie to start before my addition to the debate. If you don't mind, Amélie, could you please continue?
Yeah, sure. Thank you very much, Jeff, and thank you very much, Jana. So we've assisted a lot of clients, including real estate managers and promoters, in the upgrade of their documentation for financial products to integrate sustainability. What we can say that there are a few key takeaways from the discussions. It's an ongoing discussion with them. Sometimes we start with a discussion with a particular objective, and then we end up with another objective because realistically speaking, the ambition was not achievable. So the discussions are ongoing. It's not a topic that is set in stone. We have opinions, comments, views from different actors, from the INRE, from the IRSMA, and this impacts the interpretation of the regulation per se, because the regulation is not clear. So the first practical point that we experience is that at first sustainability was not at the table in terms of discussion for vehicle structuring, and now it's no longer seen as a trivial issue for investors and promoters. It's considered as a core topic when assessing potential investment, but also at the level of the structuring of the vehicle per se. And it's very important to take that into account, because from an investor's perspective, they are their own commitment. And it can be adherence to certain principles like SDGs or UNPRIs, but sometimes they have more commitments. Sometimes they are Article 8 or Article 9 funds. So they have a commitment to meet certain ESG or sustainable factors or criteria. And from the product's perspective as well, we need to take into account that at the end of the day, the performance and the assessment of the compliance with the disclosure is done at the asset investment level. So we need to make sure that what is done at the asset level complies with the commitments from the financial products towards the investors at the funds level. The second item that I focused on during the presentation, and that was raised by Jeff and Caitlin, is that SFDR and taxonomy are all about transparency towards investors. It's not a question of compliance, it's transparency. We need to explain what is the view for a particular financial product with respect to sustainability. Is it considered or not? If so, to what extent? If not, why? And are there any potential developments or upgrades that are possible? So that's a key topic. And I think that's the question that each time we need to talk about sustainability and work on a particular document, we need to remind, what do? We need to be transparent. What do we achieve? What do we want to achieve? What's the ambition? And that's where we start again with a lot of our clients. Each time we say, okay, we need to be transparent. What do we do? What do we do toward investors? Because at the end of the road, we have reporting to investors, we have reporting towards the financial market participants, and when the financial products are supervised or regulated, we have also this reporting requirement towards the regulator, and we need to make sure that everything is aligned, and when there's a commitment, the performance fits the commitment from a particular financial product with respect to sustainability. Another topic that is interesting is that it's a multi-party discussion between investors, promoters, advisors, and managers. And the question again is, how do we approach sustainability? But it's not a single party saying, we want to have this financial product falling under the regime of Article 8 of Article 9, because all of them have commitments, requirements, in terms of reporting, disclosure, and it's very important that everybody is aligned and all of them are on the same page in terms of sustainability. Another key item that we raised is the fact that sustainability, the way sustainability is considered is to be thought carefully based on available resources from a human and material perspective, keeping in mind that reporting is at the end of the road. And that's something that is very challenging, I know, because for some of our clients, the ambition is there. They want to be 100% sustainable. They want to target and invest in, for instance, buildings that produce energy and make sure that all their buildings are sustainable. But sometimes the tools are not there because there's no particular index designed for that, or the index is not good enough to track the performance. Sometimes it's a question of human resources, because where they are financial products with a small team, with one financial guy, one legal guy, one marketing guy, and the one available to check the performance in terms of sustainability, it's very difficult to work on and to report toward investors. So that's very important to be kept in mind. We need to consider sustainability in a way that is consistent with the resources available and the tools that can be used to track the performance of the financial product with respect to sustainability. If we move on to the next slide, another item and another comment that we have relates to those pre-contractual template pre-contractual disclosure, as explained during the presentation for Article 8 and Article 9 funds. There is a particular template pre-contractual disclosure. It's an annex, an appendix, let's say, to the documentation that is to be completed and make sure it addresses all questions raised in the template. The issue that we have is that first, it's a good point to have a template disclosure because it enables potential investors to compare from a financial product to another and see what are the particular goals and have it in a clear way and concise way, because sometimes we as lawyers tend to write a lot and we have documents of like hundreds of pages, and it's very difficult to find the information and see what is the status or the profile of the financial product with respect to sustainability. So the fact that we have a template is good, but the cons are that there's no flexibility on the template, and certain topics are redundant. And the point is that we cannot change because it's a template that's been adopted, that's been approved, and that needs to be followed by each financial product. So if we move to the next slide, the last 3 points are very important as well. The first one, it's key to remind that there's no sanction so far with respect to the choice of regime under SFDR. So whether we consider sustainability or not, whether we want to apply Article 8 or Article 9, but the risks are high in terms of reputation. Because if a financial product and a financial market participant markets the product as being a product that promotes ESG or that has sustainability as its investment objective, and that's not the case, there is a risk towards the regulators first, if the entity is supervised, toward the investors as well. This impacts the relationship because the financial product is not able to meet or achieve the particular sustainable objectives. So per se, there's no financial sanction per se, but it's bigger in terms of relationship with the investors, because at the end of the day, if we commit to something that is not achievable and achieved, investors can just withdraw the money, and that's the end of the project. So that's very important to keep in mind. Another key point or key takeaway to remind is that it's a taxonomy in progress. Some objectives are not yet defined. This applies to climate change, to environmental objectives, sorry. For the time being, we have approved definitions for climate change mitigation and adaptation. The other objectives under taxonomy are being defined, but for social objectives, for instance, there's no definition. It does not mean that we cannot take them into account and disclose them in the documentation, but it's sometimes difficult for investors to see what are the particular objective, or to see behind what's the rationale, what's the idea behind the social objective targeted for a particular product. And finally, as explained earlier, it's an ever-changing topic for which clear goals need to be clearly defined with investors and the other actors around financial products, so managers, advisors, and auditors as well, because we have to keep in mind that we have the audit running for certain entities, and the auditors will check whether the financial product meets the sustainable objectives as per the pre-contractual documentation. And again, as Jeff said, the goal is to perform and upgrade. Thank you very much.
Thank you, Emily, and Jeff, for the fantastic contribution on the topic. I want to, before I go to the core, I want to give a little bit of introduction to our members to explain what APRA has done so far on the topic, where were the priorities, and how we focus on SFDR in a practical terms. And I need to say that as Caitlin already mentioned, SFDR is part of a bigger picture, of a bigger package of the initiatives, and they all work together. It's very hard to see SFDR in isolation from other pieces of legislations or policy initiatives, because they all have one single objective, and that is to lead the transition to net zero and to meet the Paris Agreement's objectives. So this is something which should drive our understanding of those pieces of legislation. At APRA, we from the beginning identified two sets of priorities, one of which is the EU taxonomy, of course. The second one is to focus on sustainability disclosure with a more intense work on the corporate sustainability disclosure due to the composition of our members. Listed property companies are not as such impacted by SFDR, but the way we are looking and focusing our work on SFDR is a little bit different. It has a bit different approach. And these three questions are guiding our work towards SFDR, and I will guide you through them today. The first one is about how we can support investors' disclosure requirements under SFDR. And here, we know that a part of the information that listed property companies are going to provide will go to investors that they can then use for their own SFDR disclosure. And this is where APRA can step in its support. I will skip this slide. In this support, as under the SFDR, on one particular part of the information which are to be disclosed, which are for the principal adverse risk section, there is a exact set of indicators which are mandatory and exact set of indicators which are voluntary for financial market participants to disclose. And there is a match, an overlap between what listed property companies already disclose and what can be facilitated for investors' own disclosure under the SFDR. I just want to mark here that there are different indicators for listed property companies and different indicators for real estate assets directly, just to keep that distinction in mind. If we move to the next slide, we will see that APRA has mapped our sustainability.
Yep, I think the slides are being shared right now.
Yeah, we see them.
I'll just go to the right slide. Okay, so if you can hear me, I think now I'm all set. I'm taking over. Apologies for this inconvenience. So I'll continue. Our sustainability department has mapped the indicators that would match the mandatory indicators under SFDR, which are to be disclosed. And interestingly, already at this point, I believe that we can say that there is a lot of information which listed property companies are disclosing due to their uptake of the APRA SBPR. And these informations are also available for you to access freely in the APRA SBPR database. And I added a QR link through which you can access the database and also the web link, so that you can really have all routes that would lead you to the database. I mentioned already that for real estate assets, the indicators are different. There are 2 mandatory indicators which are listed. There are 5 voluntary indicators, which I didn't list it here, but we can provide you more information should you wish. I just want to point out that, of course, for some investors that are looking to invest in in real estate overall more holistically, they are looking at non-listed and listed in the same way when it comes to sustainability. So there is another kind of challenge and constraints for them that they need to overcome in terms of the data that are going to be available for them. How do they reconcile those information if indicators are not the same? And regarding the first one on the fossil fuel, I will go back. I can mark that there is one which is looking similar, number 4. So it could be used interchangeably there are also a few which are mandatory for listed real estate, but they're voluntary for non-listed. So just wanted to mark that for your information that you can take it into consideration. I move now to the second question about how is the framework in effect encouraging investors to finance transition to a sustainable economy. And on this point, I really thank Jeff for your observations. I will probably lead to a different conclusion in my presentation, but then we will have a debate on this, and we'll try to figure out how to move forward. So just to remind everyone again, and I know it was already mentioned, the objective of the sustainable finance package, and SFDR is part of it, is really to drive the capital towards sustainable investments and to lead the world's transition to net zero greenhouse gas emissions. And also to align with the Paris Agreement's objective, and to reach the final destination. So the set of legislations which were introduced as part of this package is supposed to help achieve this goal. And SFDR is just one part of the package. And it's focused on transparency, I know it was mentioned, and to protect the end investors. However, the way it was designed, and maybe it was throughout the process in the political discussions with the European Parliament in a halfway through, it does differentiate between the various degrees of sustainability related ambition. So that's why there is the ultimate objectives from the investment communities to strive for the Article 9 fund products, which are often referred to as the dark green products, because they are what you can achieve in a maximum terms. I'll talk a little bit about the Article 8 of the SFDR, not in details, and won't read everything because I'm mindful of the fact that you've heard those information from Amelie and Jeff already. But the European Commission, when referring to this article in their answers to Esna's question, mentioned that reduction of negative externalities caused by the underlying investment could be applied for the purpose of Article 8. So there is something that we can consider for this article to apply, something in a sense of disinvesting from assets which would negatively impact environment. According to this regulation, it would be for real estate the energy inefficient assets, as opposed to reducing their carbon emissions. And I will go to the carbon emissions in a while. The Article 9 of SFDR is of course the product which has a sustainable investment as its objective. We've heard that a lot, but this is a one category, and as part of this article there is another small subcategory on objective, which is a reduction in carbon emissions. It's explicit in the regulation that this article has additional kind of subcategory, and the recital of the regulation refers to these kind of products as impact products, as impact investing. It's not explicit in the body of the legislation, but it is mentioned in the recital, which is explaining the purpose and objective of the legislation. And in this objective, there is the objective of the product to, in fact, lower the carbon emissions in a view of achieving the long-term global warming objectives of the Paris Agreement. So you kind of have the implied movement towards a further goal, which is, the Paris Agreement alignment. And I would imagine that perhaps the reduction of carbon emissions by retrofitting the investment property of the portfolio would be perfectly well aligned with this legislative text. But it's true that we need to make sure that the industry is aligned with those interpretations, and that we communicate and have those discussions with the regulators who are then supervising the application of SFDR. So this is not something that it's guaranteed. We are having a discussion, and it's part of the ambiguity and unclarity in the SFDR, which is a big issue in terms of how you apply. If we are having not enough clarity in terms of how you design those products at this early stage, it's very difficult to proceed with the application with the security that it's the right way, and there would not be reputational damages later on throughout the journey. Regarding this particular provision, in the regulation, there is a reference to two set of benchmarks, which are embodied in the benchmark regulation, the EU Climate Transition Benchmark and EU Paris Aligned Benchmark. Where they are available, they could be applied for this specific purpose. And we had a question already from the participants regarding the green benchmark, whether there is something that can be done, something that can be created. And Amelie also referred to lack of availability of those kind of indexes, which could be used as a tool, particularly for smaller financial market participants who wouldn't have the resources to really accommodate the sustainability disclosure. So I have a question for you, for participants. If you feel that this is something that would be very beneficial for your own application of SFDR, please do let us know. We need to hear that from you. You can email us at info@APRA, or you can email to myself. I will have my contact details at the end of the slides, which will be distributed to you. Regarding the reduction of carbon emissions, we have a specific information on the taxonomy leaflet where you can see the scientific explanation of why we believe this has a positive impact when you decarbonize the built environment by retrofitting. You can access it through the QR code and the web link of this website. And I will quickly move to the final point, what works well under SFDR, what needs to be clarified and what needs to change. This is something that APRA will be also looking at throughout this year. First, I will focus now about what is yet to be clarified more concretely. There is a latest set of questions by ESMA sent to the European Commission, and I marked 3 of them, which are particularly relevant for listed real estate, and they are very important. The first one is when investors allocate capital to listed property companies, to investee companies, but their activities only partially sustainable, how do they account for such an investment? Is it the whole equity, which is part of the product, and it can be part of the Article 9 product, for example, or it's only in part? For example, if an investor allocates 100,000 euros in terms of the shares to listed property companies, and only 20% of their economic activities are reported to be green, is only 20% of this allocation eligible, or 100%? This is a very important question, because if the answer of the European Commission will be that only the partial allocation is possible, then there is a big question of whether there is possibility to invest into listed companies at all under Article 9. So I'm hoping to see an answer to that from the Commission very soon. And another question, which is also very important in terms of the benchmark, which I mentioned, is whether if there is a dedicated benchmark, if it could be automatically deemed to fulfill the conditions of Article 9 for both passive investment strategies and active investment strategies. And these are the questions which are yet to be answered by the European Commission. And then if the answer is confirmative, then perhaps this is the way to go to make sure that there are available tools on the market to apply in these considerations. So I will move to my, I believe it's a final slide. We will be collecting in conversations with you information about how you apply SFDR, what works well and what doesn't work well. So if you have specific concerns, specific questions and you want to engage with us, please do so, because we will package those information and we will communicate to policymakers and to regulators as well, so that we would make sure that we have the right set of information to move forward. And also ahead of the review of the legislation, which is scheduled for 2024, after the European elections, we will have more information about what to suggest for the policymakers to perhaps even change in the legislations to make it more usable in practice. And with that, I will move and I will invite Gilan Kal to explain us the ESMA strategy and next steps on your end. Thank you.
Thank you, Jana. Thank you very much for this invitation. Today I'm standing in for my colleagues, expert of the SFDR topic. So it might be of a slight disappointment to the audience. I'm not going to be able to cover into details any questions, technical question on SFDR. I'm part of the Sustainable Finance team, which is a cross-cutting team within ESMA. So I collaborate with them on certain topics, but yeah, I do not have the same mastery as them that would enable me to answer any of the technical questions. But hopefully, I'm going to give you some information that will some information about timing of some of the guidance that will be coming up that will be helpful, and also I'm going to provide you some information on supervisory convergence activities and also on the greenwashing work we're doing. That will give you some that will help you also engage with us and also share with us some of the challenges you're facing. So it's been very interesting to listen to the conversation, hear how practices are evolving, how expertise is developing in the market, and also to of course hear about the challenges that we understand the market participants are facing. So regarding, so before I dive into more specific elements, I wanted also to highlight that we published the new ESMA strategy for the period 2023-2028, and sustainable finance is one of the 5 key areas that will structure our work in the next 5 years. So it's probably not coming as a surprise. And as is reflected in this new strategy, and given the novelty of the area, but also the urgency of the sustainability agenda, the development of the regulatory framework on one side, and also supervision activities will be progressing in parallel, and we will of course, give a specific attention to the consistency to enhance consistency of the whole framework. So on the EU rulebook and guidance, so again, I will not dive into details, but let me just highlight a couple of recent and ongoing developments. The first one is that the SFDR delegated regulation, so the ESAs, ESMA, EBA, and EIOPA have produced and proposed some amendments to the delegated regulation to make sure that financial products disclosures provide information on the potential exposure of financial products to investments in fossil gas and nuclear energy activities. So that's follow up to the complementary climate delegated act that was adopted earlier in the year, and the revised RTS have been approved by the Commission. So we're expecting that will apply as part of the implementing requirements that will start applying next year. With regard to future developments, so there was also another mandate received last April from the Commission to produce a review of the PEI indicators of the financial product disclosures, refine some of these elements in the delegated regulation, So the discussions are going on right now on what this work should cover, and we expect to launch a consultation paper early 2023. So this will be an opportunity for you, for market participants, to voice so some of the early challenges in this context. I mean, this is also a very good opportunity to engage with us. And finally, regarding guidance on the current draft on the current SFDR delegated regulation and level 1 requirements, we are of course very aware that guidance is needed to support the industry. So we've been working on a set of Q&As that will cover a number of questions, and these are going to be published very soon. So these will hopefully support the preparation of the template disclosures that are applying starting in 2023. And as you mentioned also, there are a number of union law interpretation questions that were sent to the Commission by DSAs, and the latest batch, you mentioned a few of them, Jana, have been sent in September, and we're hoping that we will get that the Commission will be able to answer them very shortly. Now on supervisory convergence, as the legislative framework is gradually kicking in, we are turning our focus more and more to supervision and enforcement. So in order to I mean, giving a stronger emphasis to supervision means that we want an increased scrutiny on ESG disclosures, and we want also national competent authorities, the national supervisors, to build capabilities and make sure that sustainable finance is really part of their daily supervisory work and part of the supervisory culture. So we are going to launch a number of activities using some of the supervisory convergence tools that ESMA has can activate. And the idea, so we're doing this because it's critical that it's critical to our mandate to protect investors, and also to make sure that the credibility of the ESG market is maintained over time and developed. And it's also critical for us that there is a level playing field across the EU, so that the implementation is done similarly in every member state. So as you may have seen in October, in last October, the ESMA board approved a new union strategic supervisory priority on the topic of ESG disclosures. The objective will be to enhance transparency, comprehensibility of ESG disclosures across all segments of the investment value chain. Concretely, a USSP means that all NCAs will take into account the topic in their work program. So they will take into account ESG disclosure supervision. We are, so in this work program, one particular action that I want to highlight that is relevant to this audience is the common supervisory action that will be coordinated by ESMA starting in 2023. It will be focusing on sustainability risks and disclosures. So basically, the NCAs will be asked to assess market participants' compliance with the provisions on sustainability risks and disclosures, in particular those that are in SFDR. This work is also going to feed into the project that I will discuss in a minute on tackling greenwashing and promoting transparency. So, and one last element also maybe useful to mention is that we've issued a supervisory briefing in last May, 31st of May, where we provide some guidelines to national authorities on how to supervise sustainability risks and disclosures for investment funds. Now the last topic, so moving on the third topic, the issue of greenwashing and the promotion of transparency. So it's one of the ESMA priorities. It's spelled out in the ESMA Sustainable Finance Roadmap. It's also reflected in our new strategy. It is particularly important because greenwashing may give rise to detriment to investors who wish to allocate resources to sustainable investments. And we're in a context where demand is growing for sustainability-related products. The regulatory regime is evolving rapidly. Product offerings that have sustainability features as well. And we are still also facing data scarcity issues. So in this context, there is growing concern of potential greenwashing. We are very much looking at this with the investors' interest at heart, in line with our mandate for investor protection. And ultimately, the objective for us is really to enhance the transparency and the quality of the claims that are made regarding sustainability. And ultimately, the objective is to maintain investors' trust and the integrity of the ESG markets. So how are we going about this? Our first objective is really to clearly define greenwashing, for which there isn't really a shared definition across the EU and the financial market segments. So the idea is to have a high-level definition shared with EBA and EIOPA, and also to adapt it to the various segments of the value chain, and to develop also a better understanding of where the potential issues are, so that we can focus on the topics and the market segments or the financial products which are more prone to greenwashing risks in relative terms. So that's why yesterday you may have seen that we launched together with EIOPA and EBA call for evidence on greenwashing. So here again, the idea is to understand the key features, so collect the views of the markets on the key features of greenwashing, whether it's intentional or not, the drivers of greenwashing, what are the risks associated to it for various type of stakeholders. And also, one of the key objectives of this call is to collect potential examples of greenwashing practices, and basically to have some examples of what are the practices to avoid when we are looking into this issue. The call, also to clarify the scope, the call is covering both all of the three ESG topics. So it's really the whole ESG spectrum. But of course, we expect that there will de facto be a focus on environmental aspects, just because it's been the priority. It's been prioritized in the development of the regulatory framework, with environmental considerations being further integrated. So the call will seek input from all financial industry players, including market fund managers, financial advisors, issuers. It's really crucial for us that we get input from the whole value chain, so that we can understand where issues arise, how they can get maybe disseminated by unintentionally or intentionally by various actors. The idea is also to seek input from consumers associations, NGOs, and academics. In the call for evidence, you will see that there's a joint section common to all three ESAs. And then there are some specific sections, one specific to ESMA. So it's relevant so for market players under our remit. This is important that we get feedback on both sections, of course. Feedback, just to give you some details about the process, the feedback. So it's open for 8 weeks. The deadline is the 10th of January. This will then feed into our activities generally, but also into our response to the European Commission mandate that we received in May, that asks us to look at greenwashing risks and the supervision of sustainable finance policies. This is a mandate that we received together with EBA and EIOPA. We will provide individual reports, but we are working in a coordinated manner. So we are developing a common definition of greenwashing. Some key findings will be also jointly submitted to the Commission, but of course, each of us will also have to look into more details into what is happening under our own remit. And eventually, this should help inform policy making. So we want to take stock of the implementation of sustainable finance legislation. I mean, this is coming after. So the first step is really to understand the greenwashing phenomenon. And the CFE is one key input for us. And then on that basis, we will then work to take stock of the implementation of the relevant sustainable finance legislation to map also and assess the supervisory response. And eventually, we will issue recommendations, including potentially amendments to level 1 legislation, and that will feed into another report that will come in May 2024. So a first report on the understanding of greenwashing in May 2023, and then a second report that will focus on legislation implementation and assessing the supervisory response, and issuing recommendations in May 2024. This work for us, and really, this is something also an opportunity for market participants to engage with us, is an opportunity to really enhance the effectiveness and the consistency of the regulatory framework, and to also make sure that we conduct supervision in the most effective way. And to conclude, so I will just wrap up by highlighting again, so we understand that there is quite a number of challenges, and this is a learning curve for us collectively. That's why it's important that we get feedback, and we always welcome feedback and input from stakeholders. So it's so again, really, we strongly encourage you to participate in the call for evidence on greenwashing that has been published on yesterday, and also to the upcoming consultation paper on the review of SFDR delegated regulation that will be published beginning of 2023. And we know it will be a lot of it will be intense. It's a lot to ask, but we also cognizant that it's important that we calibrate the framework we taking into account your input. So with that, I thank you for your attention, and please let me know if you want me to answer any questions on this aspect.
Thank you, Gillian, very much for your update. I think it's very helpful and useful. I need to also apologize to participants that due to the technical issues which I had with computer, we are a little bit delayed, and we will not have that much space for Q&A. But there was one particular question which was consistent, and I was coming back from many of you. So I would like to at least answer that and address this, and I will also have a question related to that to Jeff, because I know that you had extensive engagement with ESMA on that particular topic. So I would be very happy if you could share that experience with us. It's regarding the transitional funds and green to brown to green funds, how you package them, how you categorize them. Is it possible to apply Article 9 for these particular situations, or it has to be Article 8? And we have different views on this. That's why it's very important to have a little bit of discussion on that. At this point of time, EPRA has a different view, but we will see in a couple of months after the engagement with the regulator. Could you please, Jeff, explain how you came to that conclusion, if there is something behind the doors that we should be aware of?
Sure, Jana, and thank you for that. I mean, not to disclose anything I shouldn't. I don't think there's any reason not to be transparent, but we at INREV did set up a call with our several of our experts, legal and ESG experts, and asked to speak with some of the members of Julian's team on the SFDR team to try to get some clarification on a few specific issues. And one of the issues we did focus on was whether a real estate fund with a transition strategy that had a clear sustainable objective of improving the assets to be fully sustainable assets could then qualify as an Article 9 fund because of its binding sustainable objective. And we were told very clearly that the Article 9 requirements to have a binding sustainable objective that's on par with a financial objective would mean that all the investments in the fund would have to be sustainable, and that's a static view at all times. And therefore, real estate funds with transition strategies would disclose under Article 8 until such time as all of the assets in the fund are sustainable. And a fund that is taking in non-sustainable assets, converting them and perhaps selling them on or pouring them over into another fund would be then in a situation of reporting under Article 8. Again, a sustainable objective. It's important. You have to meet the PAI requirements as well. But to us, that makes some sense as we think about it further. It is about transparency. It is about avoiding greenwashing. And to have a fund claim that we want to improve all these assets, and then an investor invests their money in it because of that intention to improve, if that's not yet realized and it's not clear how long it might take, then is that actually where the investor wants to be investing their money? So it is a question of being transparent so that investors are making informed decisions, as we understood it, and we understand that. But on the other hand, there are some issues for real estate as real assets that actually do need real world upgrading. What about an asset that has is sustainable at the moment, but the heating system breaks down and needs to be replaced, or there are all kinds of scenarios. What if you've got 99 sustainable assets and you want to buy one more and fix it up? You technically wouldn't comply then with the Article 9 disclosure requirements. We have also submitted questions to EPRA trying to get some further, to ESMA and the ESAs trying to get some further clarity on if there might not be just a little bit of flexibility in bringing new assets in or in converting just very minor aspects of things. If there is a clearly defined and verifiable timeline for doing that, a reasonable time. So we're very, very much looking forward to maybe the clarification we could get, simply to know how we should be reporting and how investors should interpret the rules.
Thank you, Jeff, very much. I just want to mention also to the participants that this is there is currently no 100% consensus on this question, and I'm very much looking forward to hear what the Commission will have to say on those 3 remaining questions regarding the benchmark in particular, because if those can be regarded to be satisfying the conditions of Article 9, I think then we will have a very interesting situation on the market, and perhaps also at EPRA a lot of work to do. Let's see. Thank you, Gilan, also for letting us know that the Commission is working intensely on it and it should be published shortly. So we will have a look very much. I'm conscious of time. I really apologize. We were running a little bit late. I marked all the questions that we received regarding the indicators and the reporting. We will come back to you on those questions. Unfortunately, we will not have a space to address them anymore during this webinar. So all it remains for me to do is I will skip all what's necessary to thank everybody, all the speakers, for your time, for your contribution. It was very valuable. Thank you to all participants for your attention and for your questions. We will continue those discussions around the SFDR. We feel it's very important to bring more clarity on the table, to generate those debates so we know what's still unclear and why is it unclear. We look forward to those discussions, which will be continuing. Thank you very much. And I think we need to close the webinar now.
Thanks,
very
everyone.
much.
Thank you. Goodbye.
Thank you.
Bye-bye.
Bye-bye.
Thank you. Bye-bye.